Today we are breaking down a massive development that has the entire crypto community on high alert. Michael Saylor and MicroStrategy have built what many call a Bitcoin empire. But a new warning from a top analyst suggests this empire could be facing a major liquidity crisis. Welcome back to XRP Economic Radar. The claim is that MicroStrategy might eventually be forced to sell 50,000 Bitcoin or more over the next 2 years. This is a shocking departure from Saylor's never sell mantra. If this forced sell-off happens, the shockwaves will hit every asset in the market, especially XRP. To understand why this is happening, we have to look at how MicroStrategy changed. Under Michael Saylor's leadership, the company shifted from a traditional software business into a massive Bitcoin treasury vehicle. The goal was to use the company's balance sheet to acquire as much Bitcoin as possible, often using borrowed money to fund these purchases. For years, this was seen as a genius move, as the rising price of Bitcoin made the company's stock soar. However, critics are now asking if this aggressive accumulation model can actually withstand a prolonged period of market stress or changing financial conditions. The word of the day is leverage. While MicroStrategy's strategy is bold, it relies heavily on debt and financial instruments to keep growing. Leverage is a powerful tool when the market is moving up, as it magnifies your gains and allows for rapid expansion. However, leverage is a double-edged sword that works both ways. If the underlying asset's price stagnates or capital markets become less favorable, that same leverage can become a massive burden. Analysts are now closely examining the financial framework supporting Saylor's holdings to see if the weight of this debt is becoming too much to carry. A major point of concern involves a specific financing tool used by the company known as STRC, or Stretch Preferred Stock. This instrument was used to raise significant capital for more Bitcoin buys. Recently, reports have surfaced showing that this stock has been trading significantly below its $100 par value. When a company's financing tools lose value like this, it signals a drop in market confidence. Even though executives reassure investors that dividend obligations are manageable, the market's reaction tells a different story. If the tools used to buy Bitcoin start failing, the whole strategy comes under intense scrutiny. The most dramatic part of this story comes from the well-known analyst Kaleo. In a recent high-profile interview, he suggested that MicroStrategy's best path forward might involve a massive liquidation. Kaleo isn't just talking about a small adjustment. He mentioned a potential sale of 50,000 Bitcoin. This statement immediately sparked a heated debate across social media and financial news outlets. Kaleo's argument isn't that Bitcoin is failing, but rather that the corporate structure MicroStrategy has built around it is no longer sustainable for its shareholders. This distinction is vital for investors trying to navigate these rumors. Kaleo raised a very tough question. How does continuously buying more Bitcoin at all costs actually benefit the shareholders of MSTR stock? For a long time, investors were happy to ride the wave, but now they are looking at the math. If the company is taking on more risk through leverage than the rewards justify, shareholders may start demanding a change in direction. This creates a conflict between Saylor's personal conviction in Bitcoin and the fiduciary duty of a publicly traded company. The pressure to protect shareholder value could be the very thing that eventually forces a sell-off. Because the crypto market has a long memory, some commentators have started making comparisons to the collapse of FTX in 2022. It is important to be clear, strategy is not FTX. There are no allegations of misusing customer funds here. This is about corporate debt and market strategy. However, the reason the comparison is being made is because of the shared themes of leverage and liquidity. Investors remember how quickly a liquidity crunch can turn into a total market panic. When people see large amounts of leverage in a concentrated position, they naturally become more cautious and look for early warning signs. You might be asking why an XRP holder should care about Michael Saylor's debt. The answer lies in market sentiment. The cryptocurrency market is highly interconnected, and Bitcoin is the primary engine that drives that sentiment. When a major player like MicroStrategy faces questions about its financial health, it creates a risk-off environment. Investors stop looking for growth and start looking for safety. This means that capital flows into assets like XRP could slow down or even reverse if the market fears a major Bitcoin dump. We all share the same ecosystem, and a storm for Bitcoin affects everyone. As we look ahead, there are several key variables to watch. First is the price of Bitcoin itself. A major rally would solve many of these liquidity concerns. Second is the performance of the STRC preferred stock and the company's ability to access new capital. Finally, we have to watch for any change in tone from Michael Saylor himself. While he remains publicly committed to his mission, the financial realities of dividend obligations and debt maturity dates don't go away. The next 2 years will be the ultimate test of whether this model is a masterstroke or a massive risk. This story is far from over, and it serves as a reminder of how complex the digital economy has become. Whether you believe in the Saylor model or you think the critics are right, these developments provide essential context for your own investment strategy. For the XRP community, staying informed on these macro moves is the best way to stay ahead of the curve. What do you think? Will Saylor hold forever, or will the market force his hand? Let us know in the comments below. Don't forget to like, subscribe, and share this update. We'll see you in the next one on XRP Economic Radar.